Hello everybody, it's Tom Sheridan and Chris Darbyshire, and here we are approaching Q3 already. Over the last couple of years, 7IM has been fairly bullish on markets, and in particular equities. We've been overweight for quite a while, and the more overweight we get, the more right we have been. And all of a sudden we get ourselves into a position now where we're looking around and are saying, how comfortable is all this long position, and do we want to keep it? Now, we just had the Asset Allocation Committee, and you could certainly paint the picture that investors worldwide are risk on. Complacency is very, very high if you want to measure that by volatility levels. Central banks are keeping policy very accommodating and low rates. As the U.S. exits QE, we have the prospect of Europe picking it up, and Japan has been picking it up. The tail risks in the world seem to have subsided. Equities have been kind of a one-way bet, Chris.
That's right. It's been a very, very benign environment indeed for equities. And we've done a good job, I think, of forecasting that will be the case. And we've tended to base our positioning on increases in valuations ahead of the increase in earnings. But I think we've reached a point now where valuations have gotten quite high in some of the more developed markets. Yep. And we're looking to rotate the portfolios more and more into markets where valuations still reflect some distress and are relatively good.
There are some risks which are creeping in. We find that the world is still very heavily indebted. Indeed, I think since Lehman, if I have my numbers right, Western governments have increased their indebtedness about 40%, which is quite a bit. Western consumers haven't really wound down all the debt that they accumulated. And what that leaves us with is growth rates sort of a little bit below trend rate, may not be big enough to help both the governments and the consumers eradicate the debt. And they leave us very vulnerable to a rate rise.
That's right. The growth rates are relatively slow, so it's taking a while for government debt to be reduced, maybe slightly ahead in the US than it is in the UK. And the problem is that with high debt and the risk of deflation, it's not a good combination, because deflation actually makes the real value of your debt more, and it becomes harder to pay off. So I think that's one of the big risks out there, and I think we're very concerned about deflation. And when you think about what central banks have done with these, massive QE programs, this is showing that central banks are very concerned about deflation.
Indeed, and we found out in Japan they don't really have a great idea what to do when they deflate. And speaking of deflation, Europe has got to be a candidate for just that.
I mean, some countries in Europe are in outright deflation at the moment, although they tend to be more towards Eastern and Southern Europe, so they're the less big economies. And I think we've had a debate on the team as to whether the policy that the ECB is setting is going to be optimal for all of Europe, or perhaps just for the core of Europe. I think we feel that it's maybe veered a little bit too much towards a Germany-centric policy and away from what the deflating economies need.
One of the perennial structural problems that Europe will have to deal with. The States has been the remarkable growth story for the last couple of years, and all of a sudden we see not such great growth in Q1. Maybe it's the polar vortex, maybe it isn't. A little amber light going on?
Definitely. I think, again, the debate on the team was whether the big reduction in US GDP estimates is purely down to the weather, or whether actually there is some underlying weakness in the economy. US GDP was marked down by 0.7% over the past few months. And that is an enormous amount for a big economy, and the economy that is driving world growth.
That's a big number if you start out with 2.9.
Exactly, yeah. So it's a third of the growth has gone. Yesterday, the Fed marked down its estimates for US GDP growth this year. So I think we're conscious of that. We're conscious that US valuations are among the highest in the world, and there maybe isn't a lot of headroom now for valuations in the US to increase.
Okay. There have been intermittent stories about China and whether or not we're actually seeing the Chinese pulling back too hard, too fast. dealing with potential property market issues, dealing with shadow banks, trying to rein in corruption. Do we see the same kind of risks in China, or on balance, are we looking all right?
So, well, I think it is actually similar risk. The Chinese, the Communist Party there, the government is trying to manage potential distress, and they're trying to pull back. At the same time, they're trying to reinvigorate the economy where that's needed. So they're trying to manage this slowdown. The difference is that at least in China, it's priced into asset values because the whole of the West is agreed that it's going to go badly wrong at some point. So you've got the chance to buy an asset which has got the potential for some economic distress behind it, but also at the price which takes that into account.
And on top of that, they haven't got the deficit issue. As a matter of fact, they got quite the reverse.
Indeed. You do hear some scary numbers about Chinese debt, but that tends to be gross debt, not net debt. When you look at net debts, China looks a lot more benign, actually, much better than the West.
I gather that the debate was a little more robust this time around at the Asset Allocation Committee. Would you like to share some of that with us?
Yes, it was. So we've had a much tougher debate this time. I think the views which have served us well over the past couple of years, which was really to invest on the basis that valuations would keep expanding, that although earnings growth would be tepid, just the benign environment that central banks are creating, and the fact that growth was actually coming, albeit slowly, would be enough to propel risky assets higher. And that's been a good call. I think the debate this time is, we've gotten to quite high levels now. We're up 30-40% in terms of valuation terms from a couple of years ago.
That's a big jump.
Right, and we're still lagging behind in terms of fundamentals. So the earnings are still slow, albeit they're coming through, and the macro environment is still slow. At what point do these forces begin to balance out a bit? So,
and one of the things that fascinates me is we've had earnings margins in companies at all-time highs for a couple of years now, and we've kind of been waiting for those margins to erode. We haven't really seen the wage pressure that probably would impact that. I guess you could probably also make the positive argument that new technology helps to reduce margins. Are these margins we're seeing, which are at all-time highs, do we think they're sustainable?
Well, it's been a great post-credit crunch for US corporations. Their margins are at all-time highs, and part of the reason for that is that wages have really been kept very much under control. And unfortunately, there you have the problem, because it's the employment side of the economy and wages and consumption that's going to get economic growth back to normal levels. Companies on their own can't do it. They're not a big enough part of the economy. So although companies are doing well, we actually need those margins maybe to come down a little bit and wages to go up a little bit for everything to begin to balance out.
So perversely, reducing margins might actually turn out to be good news.
So it would be good for GDP growth. It maybe would be bad for corporate profits in the short run.
We ought to dive right into what's going on in the portfolio. There are a couple of moves that we're making right now which will be very significant for our investors. Looking at the equity asset class and let's start with the UK. What were those debates, and what was the outcome of that very robust debate that we just had?
So in the UK, we look at it two ways. We look at it in terms of the very large companies, which are mainly FTSE 100 companies. And then we look at the sort of more typical UK company, which is a slightly smaller company. It has more of its business here in the UK, and so it's more sensitive to the UK economy. So we, in terms of large cap, these are really, the FTSE 100 are really globally diversified conglomerates, or big companies, energy companies, banks that have a very, very global feel to them. Yep. And the story there has been one of real big disappointment in earnings over the last year or two, and a big increase in valuations. And the market has lagged slightly behind some of the other stock markets. But I think we've seen valuations tick up quite a lot in the FTSE 100. and have therefore decided to take that exposure and spread it out a bit more geographically, a bit more specifically into regions where we think we've got a clear case for still valuation upside.
We do have a very regional picture if we look at the global economy, and certainly something like that makes a lot of sense to me. And we can see the regional differences play out in little things, well, big things like inflation. So if we are fanning out to other parts of the world, that infers to me that you have just cut the UK.
So we've cut the UK quite significantly. We've cut the UK in the balanced portfolio, for example, by 6%.
That's a big number for us.
So that is a big number.
6% of the portfolio reduction in UK equities.
Correct. Yeah. And we've taken some of that money and put it into the Far East.
Yeah.
And
now the Far East, just in our portfolios, is ex-Japan. Is that right?
Correct.
And I think traditionally that's a lot of Australia.
And it has traditionally been a lot of Australia. We've found an implementation approach that will reduce the Australian element of that. The Australian economy is not big enough to really justify that kind of move. So we're going to do a more sort of generic Asian approach with some Australia, but not disproportionate amount.
So money out of the UK into Asia. What are we doing with the US?
So with the US, I think we have a similar kind of problem to the UK in that valuations have really run up a lot now. And the US of the very large cap markets is one of the most expensive markets now. So we're taking a significant, in fact, we're taking a similar proportion of exposure out of the US.
Right. So that's about 25% of the holding, is it?
Exactly.
Right.
Yeah.
So that money, some of it's gone to Asia, and we've had a big story on Japan. And that's where some of that money has gone, huh?
Yes, so we actually made the tactical decision on Japan several weeks ago, and we're very fortunate in our timing in that we've caught most of the recent rally in Japan, which has been 10% odd over the last month.
Okay, so a shift in the 7IM portfolios, the equity components from the west to the east. We just glossed over Europe. We mentioned that we were mindful of deflationary pressures in Europe. What are we doing with the equity position there?
So we're trimming Europe. We have two parts to the equity exposure there. We have a large cap part. These are global companies which actually have been tarnished a bit by the Eurozone crisis. Their valuations were slower to recover. So we're going to stay with those. But what we have done is cut back our small cap European exposure. Okay. We were using that instead of UK small cap, which is very expensive and has done extremely well. And that trade-off going into European small cap had been very good for us. We want to take profits on that position.
So the trend continues, a little bit of money out of Europe to couple with the US and the UK, so money coming out of the West, and emerging markets.
Emerging markets, we've maintained our overweight position there.
It's been a pretty hefty overweight, hasn't it?
It has, particularly in the more aggressive portfolios. And it's a position that we put in place in September and are done on valuation grounds. Yep. And after a very poor run in EM stock prices. And it did take 6 months to come through, so we were a little bit too early. But it then has come through with a vengeance since then.
Okay. So if I were listening to this, I would say, my God, these guys are adding a lot of risk. We're moving out of the safe haven markets and we're moving into the higher beta or more aggressive markets. First of all, the overall level of the equity exposure has decreased, hasn't it?
It's actually decreased significantly. So it's down about 4.5%. 4.5 percentage points
in a balanced portfolio.
In a balanced portfolio.
Okay, so we're getting closer to a neutral overall equity weighting.
Yes, we've gone from 10% over to just under 6% over our neutral.
Okay, and within that equity weighting, we've gone to some of the higher beta markets, and people might say, well, that's adding risk, but actually our view is that the so-called low-risk markets have valuations at this point which actually make them higher risk.
I think that's absolutely right. The US has had a 60% premium to emerging markets in terms of valuation. So although it's regarded as the lower risk equity market, maybe if that unwinds, that might not be the case for a while.
Yes, that's kind of a similar picture that we have with gilts right now. Japan also, what are valuations looking like in Japan?
Amazingly, despite the fact that the Japanese stock market is up 60-odd% in the last 18 months, valuations haven't moved. So the market is very skeptical about Japan. It's all been powered by earnings growth, which we like.
So Abenomics is actually showing results.
We think it's showing results at a macro level, and certainly the monetary policy side of it is showing big results at a company earnings level.
Okay. So the way that we would look at the shift in the equity components of the 7IM portfolios is from higher valuations to lower valuations. And actually, in our view, that looks like
better risk to take. If you're going to take risk, why take a highly valued risk? Let's take risk where it's priced in.
Okay. Let's take that very same concept of valuations and let's go to the fixed income asset class now. For the last couple of years, you could have read any newspaper, talked to anybody. They would all tell you that, oh my God, gilts are overvalued, U.S. Treasuries are overvalued. Equities are the only place to be, but we have maintained that you cannot abandon the fixed income asset class, but that there are things that you can do within the fixed income asset class. Talk to us a little bit about what our positioning has been and how we've just shifted it.
So the worry with fixed income is that the traditional risk-free assets, the gilts and so on, yields rise, and therefore you have a significant decline in value. So what we've done is we've tried to shorten the maturity of what we're holding to try and make it more cash-like and less sensitive to interest rates generally. At the same time, we've tried to pick off fixed income asset classes which we think are genuinely undervalued. Such as asset-backed securities in Europe, high yield for a while was qualified, and at the moment we're looking at emerging market bonds. So back to the theme of emerging markets, having the risk priced in.
Yep.
We're looking at those as being, yes, they have risk, but at least the risk is priced in. You're getting rewarded for it. Whereas in the developed markets, you're getting really not much return, and values that are very, very much inflated by the central banks and
perhaps perversely, the economic numbers for some of the emerging markets look a lot better than the developed world. We're seeing budget surpluses in many of the emerging market economies that you don't see.
Government balance sheets are in very good shape in the emerging world, almost across the board compared to the developed world. And there's no threat of deflation there to make that large debt, very difficult to pay off.
So we've increased that position of emerging market debt a couple of percent, I think, from 8 to 10 in a balanced portfolio?
Yes, and what we're using is the dollar-denominated emerging market debt. Okay. So these are bonds that are issued in US dollars, not in local currency. We think there's a bit more stability there in the short term.
Okay, so the theme, both on the equity and the fixed income side of the portfolios, is trying to assess where valuation risk really is, and maybe that entails taking a slightly different view of risk than we might have done over the course of time, but we actually think that's the more intelligent thing to do. And to offset that, you've shortened maturities, and we've got a good deal of cash in some of the portfolios.
I think that's exactly right. In a nutshell, it's valuation that's been driving markets more than anything else. That means that valuation is beginning to become one of the bigger risks in the portfolios, and we are adjusting accordingly.
Well, Chris, thank you very, very much for that. As you can see, as markets continue to recover and as economies continue to grow at a moderate pace, the chore of managing your money and keeping it within the level of risk that you're looking for and still achieving the returns that you need is getting more and more difficult. And one of the things that we would stress in doing that is make sure that you watch your costs. And as you know, we try very, very hard to do that. Chris, thanks very much.
Thank you.